Okay, welcome back, students. So after knowing what is depreciation and accumulated depreciation, followed by what is the cost of NCA, so today we're going to explore methods of depreciation. Okay, there's two methods of depreciation that we need to know. The first method is called straight line method, or in short called SLM. So this method, what it does is they assume that the asset will give equal benefits throughout the useful life of the asset. So in this case, depreciation is actually using the cost and divided them equally according to the number of years it was used. So again, depreciation is is an expense, okay, and depreciation is calculated every year. But when it's straight line method, you don't have to count every year, unless the proportion of months that is used for the financial year is different. You might have to count every year. But if every year is 12 months is being used totally, then the straight line method calculation would be the same for each year for the company. So straight line method calculation need three types of items. So you need the cost item. I hope you still remember what is the component for the cost of NCA. And number two is we need to know the residual or salvage or terminal or scrap value. Now, whether it's residual, salvage, terminal, and scrap value, they are all used interchangeably according to the author. So they all mean the same thing. What it means is at the end of the useful life of the non-current asset, how much can they sell it? Again, residual, salvage, terminal, and scrap value means at the end of the useful life of the non-current asset, how much they can sell it for. Okay, useful life is how many years they intend to use the non-current assets. So depreciation per year, again, if during the financial period, the non-current asset is actually bought 3 months before the financial year ends, what happens is you will count depreciation per year and make sure you count only for 3 months, means you times 3 over 12. So always remember when you're using this formula, you're calculating for year. If you do not use the non-current asset for more than 1 year, make sure you times to the portion of the months. So if you use for 6 months, times 6 over 12. If you use it for 3 months, times 3 over 12. After, cost minus residual value divided by useful life. Or you can actually, there's another way to count depreciation. They don't give you these three items. They will give you percentage and then you time cost. Both are also called straight line method. Why? Because the depreciation amount, if the non-current asset is used fully for the one whole year, the depreciation amount will be the same for each year. So what happens is like this. Straight line method depreciation is an expense, so the same amount will be charged in SOCI or Statement of Comprehensive Income. Now, there are times that when you use straight line method, the first year might be a different amount because when the non-current asset is actually bought, it's actually 3 months before financial year ends. Now, when it comes to the statement of financial position, you need to record the cost as well as the accumulated depreciation. So it will see that the net book value, or we call it the carrying amount, would be reducing linearly like this. Okay, again, net book value or carrying amount means cost minus accumulated depreciation.